Hi guys, welcome to Money by Sunny. Today, we'll be talking about stocks. What are stocks? Can you make money from them? Are they risky or dangerous? Should you be getting into stocks? If you've asked yourself these questions, then you've come to the right place. So what are stocks? Well, stocks are basically ownership in a company. When you buy one share of Facebook, for example, you own a piece, admittedly a very small piece, of Facebook. And depending on how Facebook performs financially, if they make a lot of money and are able to keep their costs down and increase their profits, their stock price should go up and the value of your piece of ownership in Facebook goes up too. So when you buy a stock, you're effectively saying, this is a company that I believe is going to do well and I want a piece of that success. Buying a company's stock makes you a part owner or shareholder of that company, which means that you get to participate in that company's success or failure. Where are stocks bought and sold? Most trading of stocks happens on stock markets. Some of the biggest and most well-known ones in the world are the New York Stock Exchange, or the NYSE, the Nasdaq, which is also based in New York, and the Tokyo Stock Exchange. Huge amounts of money are traded on stock exchanges. Globally, over $130 trillion was traded on stock exchanges in 2020. If we look at it on a daily basis, this works out to $130 trillion divided by roughly 240 working days, since stock exchanges only operate on working days, which is over $540 billion traded daily. The first stock exchange was set up in Amsterdam, in the Netherlands, all the way back in 1602. The Dutch East India Company was a shipping company heavily involved in spice and commodity trading, and in the 17th century became the first company to issue its stocks to be traded by the public. It gave the Dutch East India Company the ability to raise money from the public quickly, and it allowed the Dutch public a way to buy in and enjoy a share of profits, and also, of course, take a share in the losses if and when they happen. Fast forward over 400 years to the present, and wherever you are in the world, there's probably a local stock market where you can buy and sell stocks of big local companies. There are actually around 60 major stock exchanges worldwide, and a total of around 41,000 companies whose stocks you can trade. You can trade stocks of tech companies such as Apple, Google, and Amazon, banks such as JP Morgan, Citi, and Industrial and Commercial Bank of China, pharmaceutical companies such as Johnson & Johnson, Roche, and Pfizer, and many, many more companies and industries. Now that we know what stocks are and where they are traded, how do you, as someone looking to hopefully make some money on the stock market, buy and sell stocks? Well, you can do this by going through a broker. Think of a broker as a middleman who connects investors like you and me to the stock market. Some of the most popular brokers in the US are Charles Schwab, Robinhood, E-Trade, and TD Ameritrade. Now, just like most middlemen, some brokers charge a fee for their services. This is called a brokerage fee or commission, and it can be either a fixed amount per trade or a percentage of the value of your trade. For example, a broker could charge fees like this: $5 per trade for transactions of $10,000 and below, and 0.3% of the value of the trade for transactions above $10,000. So if you bought some stock worth $1,000, the broker would charge you $5 as their commission, which works out to 0.5%. In recent years, however, more and more brokers are charging zero brokerage fees for trades in order to get more business. In fact, zero brokerage fees for stock trades is now the norm for most US stockbrokers, and it could be just a matter of time until major stockbrokers in other countries follow suit. If you don't live in the United States, many local brokers also provide trading on US shares by tying up with US stockbrokers. They will probably offer trading on other major stock markets as well, such as the London, Tokyo, or the Shanghai stock exchanges, to name a few. They may charge slightly higher brokerage fees for these trades though, so that's just something to be aware of. There are also global online brokers, which offer access to many global stock markets. Some of the more well-known international ones are FX Pro, Oanda, Interactive Brokers, and eToro. Now, something to take note of when you open an account with an online broker, such as the four we just mentioned, is that instead of buying the actual share, you'll be using a financial instrument called a contract for difference, or CFD. With CFDs, you don't actually own the stock, but you will be able to profit from an increase in stock prices, or lose money if the stock price goes down, just as if you owned it. There are a couple of other differences with CFDs too, which you may want to be aware of. I'll be making a video on how CFDs work too, so stay tuned. How do you make money on stocks? The most common way people think about making money on stocks is capital appreciation, meaning buy low, sell high. What this means is exactly what it says. You buy a stock when the price is low and sell it later once the price goes up. Let's look at a few examples. Tesla listed its stock on the Nasdaq in June 2010 at $17 a share. As at mid-September 2021, however, its share price was an eye-popping $755, which means that if you had bought 10 shares of Tesla at its share price of $17 back in 2010, you'd be looking at a gain of $7,380 if you sold your stock, not including brokerage fees and any applicable taxes, of course. If you had bought 10 shares of Amazon in June 2010, you'd have paid around $1,250 in total, as the stock was trading at around $125 at that time. As at mid-September 2021, however, its share price is about $3,475. So if you sold your Amazon stock, you'd be looking at a gain of $33,500. Again, not including brokerage fees and taxes. Does this mean that you're guaranteed to make money if you buy stock and hold it long term? Well, mostly yes, but not always. Let's take a look at the case of what was once upon a time the largest company in the world, ExxonMobil. ExxonMobil stock traded for around $60 in June 2010, but as at mid-September 2021, it traded for around $55. So again, if you'd bought 10 shares of ExxonMobil back then for $600, you'd be sitting on a loss of $50 if you had sold those shares. Not a huge loss, but that's not saying too much, since we're in the stock market to grow our investments after all. Why did the share price drop? Well, ExxonMobil is an energy company, specifically an oil and gas company. Unfortunately for them and many other oil and gas companies, the price of crude oil didn't grow much between 2010 and 2021. It was around $90 a barrel in June 2010 and was only around $72 in mid-September 2021. As a result, ExxonMobil's stock price didn't move much in those 11 years as well, since a lot of their profits are tied to the price of crude oil. In summary, this is probably the way most people think about making money with stocks. Buy low, wait until the value of the stock goes up, and then sell. But there is another well-known way of making money on stocks, which is via dividends. What are dividends? Dividends are payments that companies make to their shareholders, which comes from the profit that they earn. What this usually means is that the higher the company's profit, the higher the dividend paid to the company's shareholders. Dividends are paid per share, so if you own 10 shares in a company, you'll get 10 times the amount of dividend of someone who owns only one share. Dividends are usually paid out every 3 months and can range from nothing. That is, some companies don't actually pay dividends, or they pay only tiny dividends, to as high as 5% of the stock price, or even more. This percentage is called the stock's dividend yield. What does this mean? Let's look at an example. PepsiCo paid out a total dividend of around $4 per share in 2020. Let's say PepsiCo's stock price averaged about $140 in 2020. This would mean that PepsiCo's dividend yield was $4, which was the total dividend paid, divided by $140, which was the stock price. This comes up to about 2.9%, which was PepsiCo's dividend yield for 2020. Some people look at dividends as a way of earning regular income or cash flow from stocks while still holding it and waiting. Because if you think about the buy low, sell high way of making money, you'd actually have to sell your stock to cash in. But dividends can give you a way of earning cash flow while waiting for your stocks to go up in price, which is the capital appreciation method we talked about earlier. And if you're not too worried about earning the cash flow from those dividend payments, you could always use that dividend cash to buy more shares. This is called dividend reinvestment, which is a way of steadily accumulating more and more shares of a company, without actually shelling out more and more of your own money. Now that you know a little bit more about what stocks are, where they are traded, and how to trade them, how do you take action? If you think that investing in or trading stocks is something you might want to get into, the first thing you'll need to do is pick a broker and open a brokerage account. You'll need to set aside some money for buying stocks too. The amount may vary depending on your local broker, as different brokers may have different minimum account opening deposit requirements. It'll also depend on how much you can afford to set aside for stock investing or trading. I hope you got some useful insights from this video. Give us a like and subscribe if you did, and see you next time on Money by Sunny.